Stocks are sliding at midday, and the culprit is familiar: rising bond yields and a fresh wave of worry about inflation. Equity markets turned lower in recent trading as government bond yields moved higher. That combination, climbing yields and stubborn inflation fears, is a classic headwind for stocks, and investors are feeling it today. Here is why yields matter so much. When bond yields rise, bonds become more attractive compared to stocks. At the same time, higher yields mean higher borrowing costs for companies trying to grow and for consumers trying to spend. Both of those pressures weigh on corporate earnings, and markets price that in quickly. Inflation has been hard to shake this year. Some price pressures have eased from their recent peaks, but the cooling has been uneven. That uneven progress has kept the Federal Reserve cautious. The Fed has said clearly it wants more confidence that inflation is heading durably back to its 2% target before it starts cutting interest rates. Until that bar is met, rate cuts stay off the table, and that is pushing longer-term bond yields higher. There is a mechanical reason this hurts stocks specifically. Companies are valued by estimating their future profits and translating those profits into what they are worth today. When interest rates are high, future earnings are worth less in today's dollars, a process known as discounting. Growth stocks, whose profits are expected further out in the future, feel this effect most sharply. That is why sessions like today tend to hit technology and other high-valuation sectors hardest. More defensive corners of the market, utilities, consumer staples, sometimes hold up better in these moments. They tend to offer steadier, more predictable returns, which looks appealing when the macro picture is unsettled. And unsettled is a fair description right now. The Fed has not signaled any urgency to cut. Markets have been steadily scaling back their expectations for rate reductions this year. Each time that happens, yields edge higher, and the pressure on equities builds. The broader dynamic here is a tug-of-war between what the data is saying and what investors were hoping to hear. Earlier in the year, there was real optimism that the Fed would be cutting rates by now. That optimism has faded, and today's midday retreat is partly a reflection of that recalibration. The most useful thing to watch in the near term is the incoming inflation data and any fresh commentary from Federal Reserve officials. Those two signals will do more than anything else to set the direction for yields, and by extension, for stocks. If inflation data surprises to the upside, expect this pressure to continue. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.